And that brings us to mind, we were talking about banks. What about the risk of banks and the risk that they face going forward? And I'm posing this question in how they interface with corporates. And so corporates are going to rely, whether it's a Fortune 500, whether it's Microsoft or the neighborhood grocery store, they're going to have to work with their banks. And banks are going to have a posture and they're going to have an important role as we go forward. So they're going to be faced with certain risks. Do you have any thoughts, Jerome, about some of the special risks that banks will be facing?
I think the strong positive is that after 2009 crisis, they've capitalized themselves much stronger now. So going into this crisis, given it didn't begin as a financial crisis, they're actually in a pretty good situation for themselves as well as the ability to help corporates out. So I think that's a plus, given the reserve ratios that they built up over the last decade.
And I agree with you. And my thoughts also about that is that, as much as banks quietly whine and say that regulation has been too strenuous and too onerous and has been too time-consuming, whether we're talking about Basel III, whether we're talking about U.S. Dodd-Frank, whether we're talking about special service surcharges, capital surcharges for large banks, significantly important financial institutions, and whether we're talking about the Federal Reserve stress tests that apply to top banks from year to year, it appears that banks are much better well capitalized and should be able to absorb and manage through this a particular crisis. So we're talking about several layers and levels of capital, liquidity requirements, better calculations of credit risk and market risk. Almost by definition, if banks are well capitalized and if they have passed stress tests, they should be in a much better position going forward. My other thought is, how do you think that they're going to interface with clients that might be in rapid deterioration? Sometimes the bank will say, let's get out of this industry. Let's withdraw from doing business with a particular client. Instead of trying to help the client, we want to get out as quickly as possible. Any thoughts?
That's probably quite a bit of that, obviously, in the travel industry. If you look at airline financing, a lot of the asset-based financing, if you go back a couple of decades, a lot of the big banks got out of that space, and they got taken over by leasing companies. So they're definitely, from the banks at a high level, we're trying to figure out, okay, what sector do we want to focus on, as well as stay in on which ones they want to get out of. I think the other thing also that will affect the banks as well as the brokerage companies is that as the stock market goes down, obviously, there'll be a lot of margin calls, and people have to liquidate certain assets to make those margin calls. And so there's going to be pressure on the price of fixed income instruments at the same time, which is a function of just people wanting to sell to cover margin calls on the equity side, as well as people potentially selling fixed income assets to rebalance their portfolio between equity and debt. So for the counterparty risk now, with regard to people that have used securities as collateral, I think there's a lot of dynamics there with regard to counterparty risk that which may be one of the biggest exposures versus the direct exposure to corporates. In addition to that,
that's correct. Yeah. A lot of banks do have significant amount of trading counterparty risk. That's credit risk that arises from trading activities, and it can be, when you're talking about banks like Citi and Bank of America, JP Morgan, and Goldman Sachs, it can be quite significant. I do think that because of some of the new rules related to Basel and Dodd-Frank, I think banks are a much better position to manage these counterparty trading risks as well. So
so it's actually much more on it's the market risk side, which is going to figure out the shocks to the system to figure out all of a sudden you have all this gap risk, and you have a larger margin calls for whatever securities you actually have. So it's, in addition to the credit risk to the corporate borrowers, it's the market risk for their securities portfolios, which can take a big shock.
Now, one thing I think is worth bringing up, because even before the crisis, as part of accounting and credit analysis, this relates to banks. Banks had this new accounting rule called CECL, credit exposure, current expected credit loss. And the accounting rule was going to require increases in the loss reserves that banks show against their loans. So if I book a loan, I show a loan loss allowance for that loan, for the expected loss of that loan. The accounting rules had required that reserves are going to increase. And we were trying to gauge to what extent that could have impact on banks' lending policies and guidelines going forward. So even as banks the loan portfolios are going to be subject to greater levels of risk, but they're also going to be subject to higher loan loss reserves on the balance sheets and earnings as a result of this new accounting rule.
Well, that's probably a good thing, because if you go back a couple of decades, the way banks try to help manage their earnings is by let's just say massaging their loss reserves requirements.
And I understand, you're right about that. And so this sort of brings better standards for consistency, and is also a little bit more, not little, it's more conservative approach to establishing these loss reserves. So
yeah, that's a plus.
So as you had said, banks have always tried to match reserves, and this, and in terms of the system, I think it's a plus. Another thing, I'll talk about loan exposures in a loan portfolio for banks. One thing we learned from the crisis is that banks learned that there's risk in a particular borrower, but there's portfolio risk because there are concentrations and correlations.
Yeah.
And so banks manage their loan portfolios by industries: real estate, oil and gas, chemicals, consumer products. And so they did learn their lessons about concentrations and also correlations, sort of like a domino effect. And I think banks are much better off. They know what can happen. They learn lessons, and they're probably a little bit better in terms of trying to capture the risks of concentration and correlation better than before.
Yeah,
you have any thoughts?
Going back to your old shop, risk metrics was obviously developed at JP Morgan.
Yeah, yes, indeed. Yeah.
I'm reasonably familiar with that from my days. But I would say that there's a slight counterpoint, because as the world gets more global, both economically, financially, and every other way, in times of risks, correlation goes to one regardless of what you have.
Yeah, that's correct. That is absolutely correct.
And the problem with the models is that if your average correlation is not where you die, you get crushed and go out of business. It's the correlation during times of crisis, and that quickly goes to one in this global economy that we have now.
Yeah, and that's a good point. I think many of the better banks do understand that concept or that approach to correlation. So on the slide that we have here, this is just a typical bank balance sheet. And so as banks interface with corporate and corporate borrowers, they have their own a set of risks: liquidity risks, credit risks, market risks, regulatory risks, and funding risks, and those are topics that we had just described.
Yeah.
Funding risk for a bank. So if a bank wants to increase loans and support their clients, funding risk may not be as much of an issue as it could have been, in part because of support and programs from the Federal Reserve.
Yeah, and I think
one last thing I want. Go ahead.
I was just saying that if you look at the lessons from the 2009 crisis, this is one of the reasons, I'm sure, why Goldman Sachs created Marcus, their bank, to get as a funding source.
Yeah. One last thing I wanted to mention is that regulatory risk. Obviously, the bank regulators, the Federal Reserve, they want to make sure that banks operate as business as usual, but also operate well under stress. And as I mentioned, banks got these Federal Reserve administered stress tests. Other banks also do their own stress tests. The goal of these stress tests is to make sure that banks, if they have losses, if they have unusual losses, they can absorb this risk and they will continue to be sufficiently capitalized. So this is not about banks remaining solvent. It's about if banks do have losses, they'll still be well capitalized as we go forward.
Yeah.